Aston Martin. It is arguably the most prestigious name in British motoring. It's the brand of James Bond, the choice of royalty, and a symbol of ultimate luxury. But if you'd invested £1,000 into this company when it went public in 2018, today you'd have barely enough left for a tank of premium petrol. While Ferrari and Porsche have seen their valuations soar, Aston Martin's share price has collapsed by over 99%. We're talking about a drop from £19 at the IPO to just 60 pence today. Is this the end for a British icon, or is the stroll era finally about to deliver a turnaround? Today, we're breaking down the spectacular fall of Aston Martin and whether 2026 is the year it finally recovers. The trouble started the moment the starting pistol fired. In October 2018, Aston Martin listed on the London Stock Exchange at £19 a share. Investors were told they were buying the next Ferrari. The problem, they weren't. Ferrari makes massive profits on every car. Aston Martin was barely breaking even. Within a year, the company had to slash sales targets, and the stock lost 70% of its value. Then came the dilution death spiral. To stay afloat, the company has had to ask investors for more cash over and over again. Every time they issue new shares, your piece of the pie gets smaller. In fact, since 2018, the share count has exploded so much that even if the company does well, the per-share price stays in the gutter. Fast forward to today. Why is the price still at historic lows? 2025 was supposed to be the golden year, but it turned into a perfect storm. First, the debt. Aston Martin is sitting on a £1.4 billion mountain of debt. Some of that debt carries double-digit interest rates. They are paying hundreds of millions just to keep the lights on. Second, the China and US problem. New trade tariffs between the UK and the US have added a 10% tax on their cars, and demand in China has cooled off significantly. For a brand that only sells 6,000 cars a year, losing a few hundred sales in Shanghai or Los Angeles is a catastrophe. And finally, the execution. They've struggled to deliver their most profitable specials. In late 2025, they only delivered 2 Valhalla supercars when the market expected dozens. When you miss the delivery dates on a £2 million car, the cash flow disappears. So is there any hope? Believe it or not, some analysts are starting to look at these 60p shares as a bargain. Here, why? The Valhalla ramp-up. Production is finally moving. Aston aims to deliver 500 Valhallas in 2026. Because these are high-margin cars, they could finally make the company free cash flow positive. The new lineup, the DB12, the new Vantage, and the Vanquish V12 are receiving rave reviews. The product has never been better. New leadership, with Adrian Hallmark, the man who transformed Bentley, now at the helm as CEO, the amateur hour production issues might finally be over. Management is promising a material improvement in 2026. If they actually hit their targets, the stock could easily double or triple from these lows. So is Aston Martin a buy or a good buy? If you're a cautious investor, the debt levels are still terrifying. This is a high-conviction play. You are betting on Lawrence Stroll's ability to turn a boutique carmaker into a profitable powerhouse. The brand is too big to fail, but the stock has proven it can go lower than anyone imagined. 2026 is the finish line. If they don't reach profitability this year, the James Bond of cars might finally run out of gadgets to save itself. What do you think? Is 60p a steal or a trap? Let me know in the comments. Don't forget to like and subscribe for more deep dives into the business world.